The possibility of the United States defaulting on its national debt is a scenario that many economists, policymakers, and financial experts view with grave concern. Although the United States has never experienced a true default on its debt obligations in the modern era, the political stalemates and fiscal pressures that sometimes bring the country close to that brink raise serious questions about what would happen if such a default were to occur. In this video, we will explore in depth what it means for the United States to default, why such a situation might arise, what the immediate and long-term consequences could be, and how the nation and the world might respond and recover from such an unprecedented event. To understand the gravity of a U.S. debt default, we first need to understand how the U.S. government finances its operations. The federal government operates on a budget system where expenditures often exceed tax revenues. To bridge this gap, the U.S. Treasury issues debt instruments, commonly known as Treasury bonds, notes, and bills. These securities are purchased by investors ranging from ordinary Americans to large institutional investors, foreign governments, and central banks. These Treasury securities are considered some of the safest and most liquid investments globally, earning the nickname risk-free assets, because the U.S. government has always honored its debt obligations, making them a bedrock of the global financial system. A default would occur if the U.S. Treasury fails to meet the terms of its debt obligations. This means the government would not be able to pay the interest on its debt or repay the principal when due. Technically, this could happen if Congress does not raise or suspend the debt ceiling, a legislated cap on the total amount the Treasury can borrow. Without an increased debt ceiling, the Treasury cannot issue new debt to pay existing obligations, which could force the government into a situation where it runs out of cash to meet all payments. The debt ceiling itself is a unique feature of the U.S. budget system, essentially requiring periodic congressional approval to continue borrowing. This political mechanism has become a flashpoint in American politics, often used by lawmakers to negotiate other policy priorities. While this system aims to enforce fiscal responsibility, it has led to repeated standoffs, pushing the Treasury closer to its borrowing limit and raising fears of a default. Why might the U.S. default? While the U.S. economy is large and resilient, the country's growing debt load, which recently surpassed $33 trillion, has sparked intense debates about fiscal sustainability. Political polarization means that agreements on raising the debt ceiling can become hostage to ideological battles over government spending and taxation. If lawmakers refuse to raise the ceiling or delay action, the Treasury will exhaust its extraordinary measures and cash reserves, leaving the government unable to meet all its financial obligations on time. If a default occurs, the immediate aftermath would be marked by financial chaos. Investors globally regard U.S. Treasury securities as the safest assets, underpinning not only U.S. financial markets but international finance more broadly. A default would shatter this perception, undermining confidence in the U.S. government's creditworthiness. The most direct consequence would be a spike in borrowing costs as investors demand higher yields to compensate for the increased risk. This would increase the cost of financing the U.S. government's operations significantly. The ripple effects of this would extend beyond government borrowing costs. Higher interest rates would cascade through the economy, affecting mortgage rates, auto loans, credit card interest, and business financing. This tightening of credit conditions would suppress consumer spending and corporate investment, leading to slower economic growth or even a recession. Equity markets, which are sensitive to economic uncertainty and credit risk, would likely experience significant sell-offs, wiping out trillions in household wealth. Internationally, the fallout would be even more severe. U.S. Treasury securities are held extensively by foreign governments, sovereign wealth funds, and central banks, including major holders like China, Japan, and the United Kingdom. A default would force these entities to mark down the value of their holdings, incurring substantial financial losses. This could strain diplomatic relations and encourage shifts in global reserve asset allocations, possibly accelerating efforts to diversify away from the U.S. dollar. The U.S. dollar itself could lose some of its dominance as the world's reserve currency. Currently, the dollar's preeminent position rests largely on the credibility and reliability of U.S. debt and financial markets. If the U.S. defaults, other currencies such as the euro, Chinese yuan, or even emerging digital currencies might gain increased prominence in international trade and finance. This shift could alter the global balance of power and complicate the US's ability to project influence worldwide. Domestically, the government would face an impossible financial puzzle. Without the ability to borrow more, the Treasury would have to prioritize payments, which might mean delays or cuts to Social Security, Medicare, military salaries, and federal employee wages. This would cause significant social and economic disruption. Credit rating agencies, which already downgraded the U.S. in 2011 amid debt ceiling crises, would almost certainly reduce the country's credit rating further, making future borrowing even more expensive. The banking and financial system could face severe strain as well. Many banks use Treasury securities as collateral for loans and to meet regulatory capital requirements. If Treasuries lose value, banks may be forced to reduce lending or raise capital quickly, further tightening credit conditions in the economy. The resulting credit crunch could exacerbate economic contraction. Psychologically, the damage to consumer and business confidence would be severe. Confidence is a crucial driver of economic activity. Uncertainty about government stability and financial markets often leads households and businesses to cut back on spending and hiring. Such a decline in confidence could deepen and prolong an economic downturn, leading to higher unemployment and social unrest. The long-term consequences of a U.S. default could reshape the global economic order. Restoring confidence after a default would be an arduous process. The U.S. might face permanently higher borrowing costs and greater scrutiny from investors. Its geopolitical influence could wane as economic and financial leadership becomes more diffuse globally. This would alter the United States' ability to fund military operations and international aid programs, weakening its role on the world stage. The recovery path after a default would depend heavily on political and economic decisions made by U.S. leaders. To rebuild trust, the government would likely need to enact credible fiscal reforms, possibly including spending cuts and tax reforms to reduce deficits and debt growth. Political cooperation would be crucial to avoid future brinkmanship and provide markets with assurance that the debt ceiling will not be weaponized again. The Federal Reserve, as the nation's central bank, would play a pivotal role in managing the fallout. It could intervene by providing liquidity to stabilize markets and support the banking system. However, monetary policy tools have limits, and the Fed would need cooperation from fiscal policymakers to restore overall confidence in the economy. Globally, a U.S. default could prompt discussions about reforming the international financial architecture. The event might spur the creation of more robust international frameworks to prevent or mitigate sovereign debt crises and encourage greater diversification in reserve holdings among nations. In summary, the United States defaulting on its debt would be a catastrophic event with both immediate shocks and long-lasting implications. The confidence in U.S. debt securities that underpins global finance would be severely undermined. Interest rates would rise sharply, economic growth would slow or reverse, and social and political strains would deepen. The global economy would face turmoil with repercussions for trade, investment, and international relations. While the U.S. has historically averted default through political compromise, growing polarization increases the risk of future crises. It is vital for policymakers, investors, and the public to understand these risks and work towards sustainable fiscal policies and political stability to avoid such a dire outcome. Thank you for watching. If you found this analysis helpful, please like, share, and subscribe for more in-depth videos on critical global economic issues.